Thanks, everybody, and thank you, Greg. Get right into the presentation here for Ely Gold Royalties. And start out, of course, we will be making forward-looking statements. And again, start with the corporate overview, just so you know what the size of the company and the structure we're looking at. We have about 100 million shares outstanding, 143 million fully diluted. All of our option and warrants are in the money, stock trading around 44 cents. And so we have a fully diluted market cap today around 63 million. And we've got a small amount of debt that is related to a couple of transactions that we've done here recently, and investments in stocks of other gold mining companies, about 900,000. That's probably close to $1 million. So a fully diluted enterprise value right around 51 million. Share structure, 11% management, 25% tightly held friends and family. 19%, that's kind of a moving number there. It's down now. Rick Rule's been selling some stock lately, so he's reduced his position a bit. Eric Sprott is at 19%, and Eric got to 19% by providing us a line of credit here recently for $6 million to allow us to go out and purchase additional royalties. The chart, we're coming off, this is a weekly chart going back a few years, and shows that we're coming off of a very nice base and just continuing to work higher. We've had a very good year. 2019 really has been a watershed year for the company as we've begun to purchase producing royalties and the stock really breaking out. Talk a little bit about the royalty business for some of you who aren't real familiar with it. What we're all trying to do in the equity business on gold is to get leverage to the price of gold. And on the equity side, you have a few choices. The gold ETFs, which are very liquid, track gold fairly closely, but don't really offer you any leverage. The gold equities, which, of course, if you pick the right one, you can get great leverage. But as a group, the GDX, the indexes, have actually underperformed gold for the last 10 years, really. One of the reasons is there is very high risk. It's very expensive doing the exploration, and for the junior companies, it can be very challenging. Gold royalties, on the other hand, provide you the leverage to the gold price with very little exploration costs, low operating costs, zero exploration costs, and very low overhead with organic growth in the projects. We'll get into that a little bit more. Important to note that in the royalty business, as a royalty company grows, the valuation on the assets that the market assigns to the assets also grows. So your major companies, and in the gold space, there's just a few: Franco-Nevada, Royal Gold, Wheaton Precious Metals. They're currently trading really at over 2 times net asset value and 25 times, over 25 times cash flow. They generally are solid dividend players, and they are companies that are should be a part of everybody's gold equity portfolio. In the mid-tier space, they're valued a little bit lower. These would be the Sandstorms, Mavericks, companies like that. So you can see as these companies grow, you get some organic growth from that the economies of scale as the assets get larger. In the junior royalty space, where we really are playing, it's a little more difficult to put a net asset value on the assets. A lot of them are development royalties that are at some stage of coming into production or just beginning production. So a little harder to value those. But this is the point where you really can make some good money in the royalty business. As a group, this chart shows the three major companies that I mentioned, outperforming gold, which is the line on the bottom here, but also over the last 10 years actually outperformed the S&P. And it hasn't really been too bad last 10 years for the S&P. This is some charts of some of the royalty companies, and I just want to emphasize this point of the beta, the leverage that you get in an emerging or junior royalty company. When the market doesn't quite understand the assets, when the assets are just really starting to flourish. This chart here is Royal Gold, which today is $113, $114 stock. This is a period from 93 to 97 when that stock went up over 3,200%. And this was really based on just one property that they had, the pipeline project of Barracks. And you can see that every time Barrick, that resource grew, that royalty company spiked in price. And during that period, I might point out that by the first discovery at Pipeline back in 93 to this 97 period, that asset grew to about 3 million ounces. It ended up being well over 15 million ounces that's been produced there. Franco-Nevada, basically the same thing in the first few years, up over 2,400%. And one of our peers, Abitibi Royalties, another junior royalty company, in its first 5 years, up over 3,600%. This is a comparison of Ely Gold to a couple of our peer companies. You may be familiar with Abitibi, the one I mentioned just on the last slide, and Metalla. These companies have market caps or enterprise value, $188 million for Abitibi, $250 for Metalla, and $50 million for Ely. On the revenue line here, we are very competitive on our revenues with Abitibi, behind Metalla, but our revenue, as you'll see in some of the ensuing slides, is increasing pretty rapidly. But as far as the royalty portfolio, Abitibi has 28, one of which are producing. Metalla has 42, two of which are producing, and we have 36, two of which are producing, and we also have two more that will be producing this year. So we're quickly catching up, but we feel still extremely undervalued to our peers in this junior royalty space. In the royalty area, there's really three ways to acquire royalties. The traditional way that you hear about a lot for the major companies is where they actually are part of the financing package at the construction stage of a mine. Then, of course, you can buy royalties that are from third parties that are already in existence. And the third way is to take a property that you own, sell that property, and retain a royalty when you sell it. So at our stage, where we are a smaller company with a $50 million market cap, we have not ventured out yet into the construction area of a mine. We have focused primarily the first 2 years that we've been in this royalty space, generating properties, selling them, and retaining royalties. We focus in Nevada, which is the #1 mining jurisdiction in the world. And a couple of things about Nevada, other than being the #1 mining jurisdiction. If Nevada were a country, it'd be the 4th largest gold producing country in the world, behind China, Russia, and Australia. And I think Australia is a continent, so I don't know that it really is a fair comparison. But still a lot of gold coming out of Nevada. More Tier 1 mines found in Nevada than any other single jurisdiction over the last 15 to 20 years. So we have spent a few years building our royalty portfolio by staking, acquiring projects in Nevada, selling them, and retaining royalties. We have a very successful royalty generation program. The beauty of this is we get paid through the property sales and generate revenue in creating the royalties. What has been the big change for us this last year is we started taking our royalty, our income from that, and we started purchasing royalties. And we've purchased royalties generally looking for a 20% internal rate of return on those royalty purchases. Yeah. So I just quickly go through. Some of the royalties that we've purchased is from on the Wallbridge Fenelon property, from Coeur, on Jarrett Canyon, Gold Resource, Rawhide Mine. These are either producing or will be producing this next year. We have over 70 properties in play between our royalty and our sale portfolio. So this slide, I will wind it up with this slide here, is give you an idea of the companies that we're dealing with. We have our properties and our royalties are in some of the strongest hands and some of the best companies and most of all the companies that are operating in Nevada. So just basically the last slide, kind of missed my time here, is the delta for Ely Gold over the next year. We still feel like we have a re-rating coming to our royalty peers. We'll continue to aggressively grow our royalty portfolio through generation and through royalty purchases. And for the juniors, as I pointed out, it only takes one royalty, and we think that the Wallbridge royalty we purchased on the Fenelon property is growing into a Tier 1 asset. And lastly, gold price leverage in the royalty business is, as gold prices go up, our revenue goes up, but our costs do not. So with that, wind this up. Thank you.